Hello everyone, I'm Aaron, a China-born global investor. Now I am the Chief Investment Officer of a US dollar family office. We have all heard about the slogans for China like uninvestable, high risk, Japanification. Look, I'm here to tell you that if you are still listening to those 2024 old views, you are going to be completely blindsided by what had really happened in 2025. Remember that capital market always tell the truth through prices. It's no different from betting odds you see on poly market. And today, I want to pull back the curtain on China's 2025 capital market and show you the truth about China that you probably won't find in the mainstream Western headlines. Let's start with the first parameter, China's bond market. And I'll give you the punchline first. China's tail risk has essentially been cleared. To understand opportunities in stocks, you first have to look at how the bond market is pricing risk. The bears argue that China is trapped in the 1919-style liquidity trap just like Japan. But the performance of the China's bond market in 2025 sent a massive signal. The tail risk, or the chances of a total system failure, is now under control. So let me show you a chart. If you look at the chart for the Chinese 10-year government treasury yield, it doesn't look like a death knell of a recession. On the other hand, it looks like a policy floor. Here's some of the basic logic. Usually, when the economy is bad, interest rate goes down. At the end of 2025, the 10-year yield stabilized between 1.8% and 1.9%. Sounds low, right? But it was actually lower at the beginning of 2025. In January, it hit a bottom of 1.6%. So throughout 2025, we were filled with bad news, like property price collapse and the local government debt issues get serious. Everyone was saying that China would become next Japan, which means the interest rate would hit zero or go negative, and inflation would vanish. But here's the surprise. When the pessimism was at its peak in the very beginning of last year, 1.6 interest rate turned out to be the floor. Even though overseas investors were still betting the rate would go slide to zero, it didn't go that way. So why did this happen? First, the low interest rate was intentional. And sounds surprising, right? The central bank used its precise guided operations to keep the rates at a historical low level to facilitate an epic debt swap. And this is crucial. Local government financing vehicles had a massive debt with 8% interest rate, and they are the primary source of tail risk in China. By driving the sovereign rate down, the central government swapped that high-interest shadow debt into official local government bonds at only 2% interest rate, from 8% to 2%. This move reduced the interest burden by about 120 billion RMBs per year, which is huge. It's actually the same logic that Trump administration wants for the US to issue low-interest short-term debt to swap out the old higher one. China actually put it off. Second, inflation is better than you think. The term Japanification narrative relies on 0% interest rate of China's CPI and PPI. But look at this chart I show you. It's a chart of China's consumer price index and producer price index. While the PPI are still in the contraction level at negative 2%, the consumer price index has quietly crawled back to 0.7%. It's no longer zero. And this gap is underrated. The negative PPI shows that the final stage of clearing out overcapacity is coming, but the rising CPI shows that the consumption floor is still holding. Things are not just getting worse and worse. On the contrary, it might get better. With higher CPI, more and more people may be willing to spend. Okay, now let's take a look at the stock market. It's from bankruptcy to a fair value. The China's A-share and Hong Kong market are proving one thing. China isn't uninvestable. It's somehow a land of opportunity again. While the outsiders see no highlights, the stock market doesn't lie. Let's look at the performance and I'll show you a chart. This one is the CSI 300 for A-share index. It returned 17% last year. And this chart shows the Hong Kong Hang Seng index. It also surged 27% from the beginning of last year, entering a technical bull market. And for context, the S&P 500 was up about 16% last year, which is a little bit lower than the China A-share. So why is that? It's not because people expect 10% GDP growth in China. It's about the return of the risk premium. When investors realize that China isn't going to collapse, prices move from bankruptcy level back to normal level. However, it's not a rising tides lift all boats market. It's highly polarized, reflecting two facts that Western analysts often miss. And let me tell you which two. First, the massive efforts in China to end involution, or cutting-throat competition. Second, the arrival of the hard-tech sovereignty. Let's take a look at the first one. Involution, or 内卷, was one of the world's buzzwords for Chinese manufacturing. For example, long hours, low pay, and relentless price war that floors the global. For industries like solar power, electric vehicles, and lithium batteries, those were the star sectors where profit were burned into the ground in 2024 because of the senseless price-cutting war. But somehow in 2025, the capital market tells a different story. The solar ETF was up 27%, and even more, the electric vehicle ETF was up 57%. And why? Because in 2025, ending involution became a national strategy. And remember, in China, when something becomes a national strategy, it's no longer a suggestion. It's a political mandate. Regulators stepped in and told solar and EV giant, stop the profitless action and behave normal. Let's take the solar industry for example. In the early 2025, prices fell below cost, which means the more they produce, the higher losses they have. And the government called the giants like Longji and Tongwei, those two companies, for self-discipline meetings and set a red line. Bidding below cost is now a violation. The effect was instant. By December 2025, prices stabilized. Longji recently stated that the industry is returning to rationality, and the capital market followed. After 6 quarters of outflow of capital, the money is pouring back into the solar sector, and China is moving from being a price butcher to a profit seeker. And finally, let's take a look at technology. It is a completely different story. It's booming for sure. If you think the US sanction killed Chinese innovation, then you are dead wrong. The sanctions actually created a massive exclusive domestic market. They forced the Chinese technology companies into a period of hypergrowth. Let's look at China's Nvidia and AMD. Yes, you heard it right. It's not the Nvidia in the US. It's a different version of Nvidia in China. The name of the company is called Cambricon. And yes, if you remember, we talked about Cambricon in our previous episode. And let me show you a chart of its stock price. You can see that their stock price surged over 100% in 2025. Why? Because with Nvidia's high-end chips cut off, giants like ByteDance and Alibaba had no choice. And rumor has it that ByteDance ordered 200,000 chips from Cambricon for AI training. And in a market of 1.4 billion people, they are the only choice. So the stock market is overexcited and paying for that. So the capital market is overexcited and they are willing to pay for that scarcity. And here is the picture of Moore thread and its stock price. It went IPO in December last year, and the stock price popped over 400% on day one. So even though the company is not making money yet, investors are not looking at today's losses. They are looking at the order books, which means how many AI chips they are going to sell. And both Cambricon and Moore thread has a fully loaded order book for next year. So even if Nvidia can still sell some chips to China as agreed by the US government, Chinese firms have learned their lessons. They must have domestic backup, and they cannot rely on Nvidia anymore. And it's not just about AI chips. Do you still remember the DeepSeek moment in the very beginning of 2025? And also, do you remember that there are hundreds of thousands of AI agent startups in China? Yes, AI is not dying in China. On the contrary, AI is booming in China. So decoupling didn't stop innovation, it accelerated the drive for independent technology. In a way, they have the US to thank for that. Whatever the headline says, the capital market is voting yes on Chinese technology. So let's go back to the ultimate question. Is China getting better? Is it really uninvestable? The answer is clear. China is in a revaluation window, and the Chinese market has not become uninvestable. It's just become more selective. It no longer rewards blind speculators. It rewards people who can read the policy logic. Under the shadow of Japanification narrative, China is carving out a different path, and one driven by painful supply-side cleaning and aggressive innovation. So next time, when you hear the doom and gloom news reports, just remember, the media might lie, but the capital market always tells the truth.